5 minutes.
Thank you, Chairman, and I want to thank our panelists for being here today, too. Look, as a strong proponent of a state-based system, I think it's a tremendous example of states' rights, something that's worked significantly well. And Ms. Wade, especially as a regulator, I think that you can attest to the fact that state-based systems have had a strong track record in terms of solvency. And could you just elaborate a little bit on why?
Sure. So since the financial crisis, the states have made a number of improvements in our financial solvency modernization initiative. So we have taken a number of steps forward in terms of having companies put together an own risk solvency assessment. It's called an ORSA, where they look at their entire group of insurance and non-insurance entities, talk about the risks, how they're addressing the risks, where they are in the continuing of solving the risks. We've done a lot of initiatives in terms of improving corporate governance disclosure.
And risks are heterogeneous across this country. I mean, the risks in Florida are different than the risks in Connecticut or California or somewhere else. So it requires that local, if you will, state perspective on assessing those risks, also in terms of solvency, also in terms of consumer protections. Now, Professor Schwartz would suggest, however, that there is a greater degree of purity at a federal level that would allow for the states to be monitored, because apparently state regulators and state legislatures who are behind the certificates of authority that give these insurance companies that opportunity just can't monitor sufficiently. In other words, you all don't have it right on fraud, waste, and abuse. You all don't have it right on consumer protections. And if it wasn't for the white horse of the federal government, you know, you all might not be needed in this market. How do you respond to that when we have a process that has worked for 150 years, probably better than any other regulatory scheme this nation has seen?
We work very hard to look at what we do every day. Our job, first and foremost, is consumer protection. And we look at our system and we adapt to, we see things coming in the future, we address those issues. We are accountable to governors and state legislators for what we do. And we are-
And you're accountable to consumers, to policyholders. And can you imagine the IAIS not only imposing different capital standards, but also different consumer protection standards? Is that not a possibility?
That is a possibility.
And should not we have somebody at the table with insurance experience and a regulatory scheme at the table with the IAIS instead of somebody in a regulatory scheme for the federal government?
It's very important to have regulators that work day to day in regulating the U.S. insurance markets at the table to explain how the system works. Our system is different than the European systems and others, and it's very important that state regulators are at the table having those conversations.
Thank you. Mr. Means and Mr. Elmer, real quickly, what is the true impact here in terms of consumer protections, in terms of the products for the consumers? I mean, if we're talking about increased capital standards, if we're talking about greater regulatory burdens and compliance on behalf of domestic insurance companies, does that not go against what you have a fiduciary responsibility to your mutual members?
You're directing that question to me?
Yes, sir.
Yes, we do. Being a mutual insurance company, our members are the owners of our insurance company. Any cost that we incur that's unnecessary is just added to our premiums that our insurers
Cost
have
of
to pay.
compliance. The number one job in the country today is a compliance officer. Isn't that a shame? And Mr. Schwartz, Professor, you're a professor of law, and God bless you because I'm a student of the law. You have to believe in due process. And if you believe in due process, then why not, if we're going to have SIFI designations, which I think MetLife was pretty successful in showing that they didn't need to be, and when in fact the only person on FSOC who has insurance background who served as an insurance commissioner said, do not designate them. They designated them. The court goes back and say, hey, you know what? You shouldn't have designated them. But if you're going to designate a non-bank financial institution as a SIFI, would you not agree as a lawyer that they should have due process? One, they should be put on notice that they're being investigated. Two, you have an opportunity to correct that. And three, once you get a chance to correct that, there is a period of time by which you will be reassessed. But that doesn't exist today, does it, Professor?
Actually, that's not correct. They were.
No, there is no due process as a SIFI.
Well, do you want me to respond?
Designation.
Or no?
Go right ahead.
They actually, that's not correct. They were told at stage 3 that they were being
At
considered
stage 3.
At stage 3.
Where was stage 1?
They were allowed.
When did they know about that?
They were allowed at that time to meet multiple times with FSOC staff. They presented their case. They had multiple meetings. And at the end of the day, they were designated. One other thing, I believe you mischaracterized my testimony. I never said that the federal government should have a role in consumer protection. I said that the federal government should have a
Should
role
monitor,
with respect.
should monitor. Does that
monitor.
not be, is that not a
Absolutely.
broad brush as to what the insurance industry is allowed to do?
So you
as
don't
part of
want to
their
monitor
performance?
state insurance regulation? I thought that.
I think we do monitor well, and I think Mrs. Wade has testified to that, as have all the other 50 states who have done very well in protecting their consumers. I yield back.